Whether it's tariffs, inflation, or election headlines, there's no shortage of noise right now. But underneath all of that is a more important and more enduring question. What's really going on in Canada's economy? Not just this week or next quarter, but in terms of our long-term trajectory, our resilience, and the structural forces shaping our future. My guest today is someone with a rare depth of perspective on that. Stephen Johnston is a managing partner at Omnigence Asset Management and one of the most seasoned capital allocators in Canada. Over the past 30 years, he's invested across some of the most complex and volatile markets in the world, including Eastern Europe after the fall of the Soviet Union, the Baltics, and the Middle East. He's also helped pioneer Canada's alternative investment space, including launching the first RSP-eligible farmland fund. He brings a global lens, a historical one, and a sharp focus on what's happening right here at home and why it matters to investors. Stephen, before we dive in, would you mind starting with a bit of background on your career and what brought you to this particular vantage point?
Sure. Well, first of all, I'd like to say that's the kindest introduction that anybody's ever given me. So thank you very much. Now I've got a lot to live up to. This is going to be pretty tough. I was well, very long time ago. I was a lawyer. Then I went to London Business School, and after I got out of London Business School, as you mentioned, I started investing in the former Soviet Union. Mostly like Ukraine and Russia and Hungary, and the Baltics, and then came back to Canada with an idea of investing in the real asset space. And I guess the reason I mentioned that is that investing in those markets gave me a real sense that you have to deal with macro risk. You have to be really alive to risk, because what generated the returns in those markets was it was actually less to do with specific company selection, and it was much more to do with understanding the macro really clearly and eliminating the big risks. Because if you didn't, do those last two things well, you didn't tend to make money regardless of how well your other picks were, right? So I've always brought that sort of macro picture to the table, and particularly in a world like post 1971, the U.S. went off the gold standard, and we've really lived in a world where macro has really been a big force in investment returns, particularly monetary policy and real interest rates, and you just can't ignore those things. And so we're big believers in layering that over everything we do, and so hence. We've got a lot of opinions on, stagflation and tariffs, and probably more so than anybody who's investing in private equity, because they tend to be much more focused on, company selection and those kind of things. But I just don't think you can ignore those factors, right?
Yeah, absolutely. And you touched on a couple of things. There are risks, the macro, and so certainly that'll be those will be key items as we go through in our discussion today. Of course, over the last couple of months, or I guess maybe since Trump's inauguration, it's he's probably in every single article that's being written, in every single headline, of course, over the last couple of days. So clearly, there's been a lot of noise lately. The tariffs, Trump, trade wars. What do you think people might be missing in all of this?
Ooh, okay. Well, I mean, we can let's address that question in maybe two parts. We'll talk about tariffs, and then we'll talk about the consequences for Canada. But I think actually, when I see the mainstream discussion about tariffs, I think it misses the overall strategy. And you can debate whether the strategy will work, but you've got to accept that the administration has a strategy. And that strategy is that America has decided it's a national security issue to reindustrialize. Right? That it's finally dawned on them that military power is downstream of industrial. But you can't be the world's hegemon if you're not the world's leading industrial power. And now you can argue whether it's a good thing to be the world's leading military power. And we'll put the ethics and the politics of that aside. But America truly perceives itself that it's necessary for it to be that. And so the tariffs are just the opening volley in America's reindustrialization. And so the idea that we'll negotiate these tariffs and everything will go back to normal, I think is short-sighted. I think that America needs to reindustrialize, and I think that the Democrats and the Republicans, and certainly the military-industrial complex in the United States, thinks that that's a high priority issue. And so what does that mean? It means you have to pull investment capital into the US market. And the challenge is that there's a finite pool of investment capital. And the EU gets some, and Canada gets some, and Mexico gets some, and China gets some. And so what America's done is said, okay, this is a zero-sum game. And our trading partners are attracting investment capital because they're using the US as an export market for their products. So we're going to stop the US being an export market, and we're going to pull that investment capital into our market. But of course, because it's a zero-sum game, it's going to drive down growth in its trading partners. This is the theory, and drive out growth in the United States. But I would suggest that if that doesn't work, they're not done. There's lots of other tools at their disposal, right? There's intellectual property disputes. There's health and safety. You know, we'll inspect every part coming across the border from Canada for fentanyl. And so instead of a part taking 45 minutes to cross the border and be on an assembly line, maybe it'll take 7 days. And maybe we'll get into an intellectual property fight with Europe, and we'll want, reciprocal reinforcement of intellectual property legislation. You know, they've been disputing that for years. And so I think that if they don't get the result that they want from tariffs, it's not over, is what I say to people. And because what they want is capital being pulled into the US, the challenge to our growth is not over. Because until they get the capital, they're going to just keep trying other things.
Right.
Sorry, that was a very long-winded answer, but I think that, I guess I could have said it briefly. If tariffs don't work, they're not done, because tariffs aren't the goal. Bringing capital back to the United States is the goal. And if tariffs don't work, they'll just use other tools.
Right.
So we have a long-term issue. And sorry, I answer questions in a very long fashion. But obviously, part of a total strategy, they're saying, okay, tariffs, and it's going to have a negative impact on the economy, but we want to pull capital in. So what other things can we do to pull capital in? Reduce capital gains, reduce corporate tax rates, reduce personal income tax rates, and slash regulation. Like any project that commits more than $1 billion gets pre-approval on the regulatory side federally. So they've got a complete holistic strategy. And so, now we can sort of segue into Canada. First of all, tit for tat tariffs. When you're 1.2% of their market, and they're 22% of our market, and we're 1.2% of theirs, is a recipe for failure, I would suggest. And we're just being reactive. Like America has a total strategy because they know what they want. They want capital to flow in. We just want the tariffs to stop. But we need a holistic strategy too, because what we need to do is prevent capital being pulled out of the Canadian market and into the United States. Otherwise, our growth is going to suffer. Sorry, I will stop at that point, and I guess this is a very long-term issue, particularly for Canada. It's right. Not one and done.
And yeah, I mean, and that was really well put. I think this conversation is mostly going to focus on Canada, but I think you raise a great point. This is April 4th, and U.S. markets are crazy and stuff like that. And I have a note going out to clients later today, and in there I kind of hint at tariffs are part of, I guess, a bigger package of stuff that's meant to come forward for the U.S. And of course, it's the most painful part of it, but the tax, potential tax relief, regulation relief, and then there's these Mar-a-Lago Accords that are supposed to happen. So very significant items coming down the pipe. Some potentially very good. Some obviously with tariffs here, quite challenging. As we sort of think about global markets.
Yeah, and and unfortunately for Canada, they think tactically, and so they've said, okay, we need to pull capital out of our trading partners' markets. Well, let's find the weakest trading partners and let's make an example of them. And I give you 3 guesses who they think their weakest trading partner is Canada. This is because we were disproportionately reliant on their market, and so we've kind of we've put ourselves in that position. We obviously need to diversify where we export goods. The unfortunate thing is, it's just very economically logical to export to the United States. It's a massive market. It's right at our doorstep. We speak the same language, et cetera, et cetera. But they're going to But their real trade war is with the EU and China. And they're going to do the EU next, and then they're going to do China last, because China really is, it's the same. That's a big challenge, right? And China already gets the strategy. They've already told domestic Chinese companies, you will not invest in the United States now, because they know exactly what the strategy is to pull capital out of their trading partners' markets. China went to the heart of the matter instantly. They said no Chinese company can make an investment in the United States now,
Right.
of domestic plant and infrastructure.
Yeah.
Because they understand exactly what's going on.
Yeah. Yeah. It's certainly a lot of changes happening, and if I'm thinking of it back here in Canada, and you mentioned Canadian weakness, one of the, and you may have mentioned it here, but on a call that I was on, you had mentioned what's happening here in Canada is stagflation. And for the audience, for someone who doesn't sort of live in the world of macroeconomics, what does that really mean in terms of day-to-day life?
Okay, well, so just definition. Let's get the definition aside, and we can talk about the impacts. So, I mean, think of it as above trend inflation and below trend growth of sufficient magnitude so that, in inflation adjusted terms, the economy doesn't grow or actually contracts. Regardless of what the nominal rate of growth is, that's not the number to focus on. It's the inflation adjusted per capita number. And Canada's had stagflationary conditions for a decade. And the tariffs are just the proverbial straw that breaks the camel's back. Like, they hit both things. It's the perfect storm. They drive the inflation piece because they drive down the dollar, right? And there's a lot of goods. We run a current account deficit. It's goods we don't produce domestically. Like, we don't produce software and supercomputers and televisions. Like, we will import those goods regardless. It drives up inflation, and obviously hits the growth side of the equation. So tariffs, if you have like domestic stagflationary conditions, which we do, and we could, if you'd like, talk about why, but we clearly do, they're the perfect thing to make them worse, because they make both parts of the equation worse. They push up inflation and push down growth. And then now, as to the consequences, the problem is, this is going to sound heartless, but we'll leave that bit to later. But okay, so the effect that you'd see, it's very pronounced in the economy, is that stagflation tends to increase. If you think of income as a big distribution, there's low income and high income, and there's middle class. During stagflation, the middle class tends to shrink. It comes under a lot of pressure. And you tend to see the ends of the income distribution tend to increase. And it's called the socioeconomic order. Think of it like a barbell. The ends get big. Now, if you're positioned correctly, you can make, it's a very big change in the economy. You can make actually very good returns, because certain things start to grow just much more quickly than they would have done historically. And we can talk about examples in due course. But that's the real thing that people, when they're trying to put their finger on it, like, why the economy feels so bad, right? It's because you're just, in real terms, and people know this, or intuitively or probably explicitly, their income in real terms is going down. And the growth in the economy isn't there, and that disproportionately contracts the middle class. And that is an important thing, because I make this one comment all the time. For the last 30 years, I would say that the majority of investors in the West have been long growth and short inflation. If you think, without knowing it, they're very short inflation, they're very long growth in their portfolios. And we're in a world where I think you should be shorter growth and longer inflation if you want to keep making returns. If I had, simplify the thesis. Now, if you get shorter growth and longer inflation, I think you can still make the same sort of returns. But if you stay long growth and short inflation in a stagflationary world, you will not generate the same returns. You can't expect strategies that worked for 30 years in low inflation and high growth to work in stagflation. They do not. And in the 1970s, I'll give you an example, stocks, bonds, and commercial real estate massively underperformed.
Right.
Massively underperformed. They didn't hedge inflation well. They didn't hedge economic contraction well. That's a misnomer. There's this misconception that people think, well, the public equities hedge inflation. They hedge low levels of inflation fairly well. Volatile inflation, changing, or high levels of inflation, they don't hedge at all. And so, think like you can't have a portfolio and say, I'm going to ignore stagflation.
Right.
Because you won't get the same, you will not generate the same returns.
Right, right. And I guess like, and certainly, we'll talk I'm going to sort of talk about portfolios stuff, in a moment, but I guess for the average person, wage earner, what they feel in stagflation is, hey, everything is just getting out of reach for me. Like the expenses are going, I'm getting a raise, I'm still employed, I'm still getting paid, all of that's seems good, and it would have been good years ago, but I'm just not keeping up, and that's kind of the case. And your point on the portfolio around being being levered to growth, and or being exposed to growth drivers, I suppose, and less to inflation drivers. I think that would also apply, in people's lives, right? So, it's I think the idea that you could own an asset that just you could have a bond, for instance, that pays you stable income, and as long as everything keeps growing, that you'll kind of you'll be fine, because that keeps getting renewed at at better rates, and in your life, you're you're just what's someone doing in their life if they're if they're short inflation? I suppose like they're buying, they're making long-term commitments, or not locking themselves in at these lower rates or something along those lines.
Or they're holding 20-year bonds.
Right.
Right. If inflation goes up, they take a bath.
Right.
That's a very extreme example, but it's just embedded in most investments, right? It's just like that's why it's so pernicious. It's like people don't realize they're long growth and short inflation.
Right.
But I think that it's pretty easy to see the effect. You look back at how your portfolio behaved when inflation spiked to 9% in Canada, and I would suggest it was more like 15%. CPI doesn't measure inflation. It measures an increasingly declining standard of living, right?
Right.
That's kind of a joke, but it's not funny, but it's actually kind of sadly true. And so you could see how your portfolio behaved, right? So, I mean, people always say, well, what's the solution? And the challenge is that the lion's share of the investment capital is in the middle class. And the middle class comes under intense pressure in stagflation. And the reason why it's such a terrible set of macro conditions, it's really quite hard to insulate yourself. It's really quite hard to generate offsetting returns. You have to be very selective, very targeted, because the universe of things that behave well in high growth, low inflation is huge. There's like most assets behave well in the world. The universe of things that behave well in low growth, high inflation is actually small. You have to do the work, find them, and invest them.
Right. Yes. Yes. Absolutely. And as we're jumping into the stagflation point, you mentioned, speaking about sort of why you believe Canada's in this position, or how we got there. So I guess, from your perspective, I mean, what's maybe from your perspective, it's loudly, but maybe to everyone else who might be quietly changing in the economy, that most people might not be noticing until it's too late.
Yeah. Well, we wrote for those that are inclined this way, we wrote a big research paper, and you can just go on our website and grab it, and it's very detailed. But I'd like to put it into sort of, big broad brushstrokes. So on the inflation side, we have a structurally weak currency. We do. We run fiscal deficits, and that's at the federal, provincial, and municipal level. So we consume more than we produce, and we fund that consumption with debt. And we grossly underinvest in productive capital. And the limited amount of fixed capital investment we make in Canada, and it's much lower than our peers, is disproportionately in residential real estate. 40% of all Canadian fixed capital formation is residential real estate, which we do at all-time high prices with records amounts of leverage. So if you want the poster child for what drives up inflation, a weak currency and fiscal deficits and current account deficits. And because you fund those with debt. And eventually, the fiscal deficit, the central banks step in and either monetize it or they push down interest rates to make the servicing of that sustainable. But eventually, this, like, the payment on that large federal deficit becomes big enough as a line item where it becomes a funding problem. They can't fund it at high interest rates. You have to push down rates. That requires money printing. So if you look at the history of governments that run sustained fiscal deficits, they have inflation problems. That's the inflation side of the puzzle. And then on the growth side of the puzzle, we underinvest in productive capital. And I won't delve into the politics of why we do, but we do. And until we started, like, it's not complicated. If you want affluence, you need to encourage the formation of fixed capital. If you want poverty, impede capital formation. Because what's the poorest possible set of conditions? A place with no capital. That's as poor as you're going to get. And so Canada, for some reason, has this view, and it's held throughout the voting populace, that we don't need to invest in fixed capital, like that we don't need to invest in production and fixed capital and infrastructure. Somehow we can run a consumption services-based economy and run a current account deficit perpetually. That's a recipe for poverty and inflation, which is just another way of saying stagflation.
Right. And I guess, like, you know, that sort of leads me pretty directly to my next question. I mean, you've seen a range of economies, right? So from Eastern Europe to the Baltics to the Middle East, go through crisis and reinvention. I mean, what patterns do you notice? And, you know, I guess how does that dovetail into what you might be seeing here in Canada?
That's a great question. That really is, because it's like, we don't need to guess. It's like there was this little laboratory and it was called the former Soviet Union, and it collapsed and it subdivided into, I think 20 countries. Don't hold me to it, but roughly that. And the Baltics, this is how they responded. Estonia cut corporate tax rates to zero. They deregulated their economy. I know this is going to be politically controversial, but they did that. They experienced massive growth. So did Poland. Ukraine, Romania did not. And they experienced no growth. They had very high taxes. They were very corrupt societies. There was regulatory barriers to investing. There was regulatory barriers to getting your money back, more importantly. And they restricted fixed capital investment, and they had poverty. They didn't grow. Estonia, particularly, and Latvia deregulated, cut taxes, and encouraged capital inflows and encouraged capital formation, and their economies flourished. And they all started from the same point. Right. You know, like they all started with their economies were devastated. They had all this Soviet infrastructure. You know, and the Soviet Union was set up to not allow countries to separate. You know, like if bauxite was mined in country X, it was shipped 7,000 kilometers to country Y to be smelted. No one does that in the West. You know, where you mine it, you smelt it, right? Things like that. It was meant to be monolithic and indivisible. And so they were destroyed. And, you know, some were overt about encouraging the influx of capital, and some were restricted. And the outcomes, you know, 20 years later are conspicuous, like night and day.
Right.
And, you know, and sorry, it's like, you know, there's always this question. If I gave you $1 million, what would you study? What causes poverty or what causes affluence? Well, we know what causes poverty. It's just you impede capital formation, right? Like Canada needs to decide. We can either focus on increasing our standard of living, and that requires increasing fixed capital formation, or we can decide that we don't like what comes with that, and you know that's relying on our comparative advantage in resource extraction, right? For now, for the foreseeable future, we can do other downstream activities and other things, but we clearly have a comparative advantage in the extraction and distribution of natural resources. If we don't want to embrace that, we can't then complain about a declining standard of living. We just can't.
Right.
Like, and we can, maybe we want that because we don't want what comes with mines and all those other things, and that's a choice as a country. But no one can say that, well, I was surprised that we became poorer, because like, they don't get to say that in 10 years.
Right. Yeah. I mean, Charlie Munger, and I'm gonna butcher this quote, but he has this quote of, I want to know where I die, so I never go there.
Yeah.
Right. So it's kind of the idea of, like, how do you, it's like you can kind of sort of get a sense of, okay, well, what we want as a country, what we don't want as a country are these things. So let's just recognize the path to those things and not do that.
Yeah. Right? Yeah. And, and honestly, like, for the G7, growth is absolutely critical, because we have enormous debt levels, and like this, I'm sorry, but with all due respect to politicians, when they go, well, it's federal debt and there's public and private debt, that's nonsense. There is only one person who pays debt. That's taxpayers. They pay the private debt and they pay the public debt. Canada's massively indebted. It's the second highest level of debt to GDP in the developed world, only behind Japan, when you have private and public sector debt. And we have these demographics of, people getting older and retiring, and we need growth to deal with that problem.
Right.
Because there's only two ways to deal with those problems: either inflation, you inflate away the debts, or you grow your way out of the debts.
Right.
Or you repay. Well, I don't know about you, but I don't think every person in Canada has $70,000 in their bank account to repay the federal debt. I think that's what it's at now, $70,000 a person, right? Yeah. No, sorry, $50,000 a person. So we're all on the hook for that individual, every single one of us, right? And so the only way to grow your way out of that is either repay it, which we clearly cannot. You either inflate or grow. And trust me, middle-class voters should be voting against inflation, because inflation destroys the middle class. Right.
And so, coming maybe now to the allocation of capital, and you mentioned productive capital, when you've seen countries and investors navigate, the situation well, whether it's, the uncertainty or stagflation, kind of anything that we spoke about, what stands out? I mean, how is it that they allocate? How do they think? How do they adapt? Like, what's even just like a mindset type of thing?
Well, there's that, now I'll butcher another quote, and I think actually this is another, I think this might be another Charlie Munger quote. It takes a lifetime to build a reputation and seconds to lose it. I think that is Charlie Munger.
I think it is, yes.
Well, we've lost our reputation, Canada, as being a receptive place to invest. The world perceives us as antagonistic to investment. And we need to work on that, because, like, even Canadian allocators, like, there's $2 trillion, I believe, of Canadian pension plan assets. Only 25% is invested in Canada. So even our pensions take one look at the regulatory tax environment in Canada and go, no, we'll invest somewhere else. Thank you very much. Right. Because they're fiduciaries. They're telling you, actually, that's a very telling statistic. Fiduciaries, whose obligation is to generate returns for their beneficiaries, who are retirees and pending retirees, say, no, Canada isn't the best place to invest that money. And so we need to make Canada a better place to invest money. If you work backwards from that, what does that mean? It means all the obvious things, right? We got to deal with either the reality or certainly the impression that our regulatory environment is hostile to investment. And people won't like to hear this, but tax rates, there's a global competition in tax rates. And if America starts to slash tax rates, we've got to compete with that. Taxes, regulations, to draw capital back into the Canadian market, that's critical. Because, well, sorry, if we decide to take the steps to say, yes, we have this massive endowment. Like my friends, and I worked a long time in Europe, they call me and say, I don't understand. Canada is the second largest country in the world. It has 40 million people. It's peaceful, orderly, has well-educated population. It has low crime. And it has one of the largest resource endowments per capita in the world. Why aren't you the richest country in the world? Like, it's a head scratcher. Like, I have Dutch friends who are like, give it to us. We'll do something with it, right? And now I know it's not, people don't like those extractive industries, but we have to start somewhere.
Right.
Like, you can't catapult yourself into supercomputers and quantum, microprocessors and software instantly, right? You need to build up all the infrastructure and all the people and the networks to do that. We can certainly very quickly capitalize on our resource endowment. And then, we can start to diversify after that. We've got to make that decision, and then that's the work ahead of us. We decide we want to do that, and we've got to deal with how we're perceived globally to capital allocators. Because America's gone full 100%. We're pulling every single dollar we can out of all of our trading partners, every single investment dollar we can, however we can do it. Whatever dirty trick, we're very upset, we're friends. It's like, yeah, we are friends, but you're Canada and we're America, and we're reindustrializing. If it means we have to drive right over you, we'll do it.
Right. And so a big part of that, I guess, is really and we don't want to get political on here, but that's democracy. We vote.
Yeah.
We make the decisions that you were describing with our votes, based on what we believe our politicians are telling us, so on and so forth. I guess the other piece is, as an advisor myself, and an investor myself, and I suspect that all the fiduciaries and the pension funds are thinking the same thing. If we're investing in Canada, let's say 25% in the pension fund, or I think Vanguard's talking about 30%, is the right allocation. Canadian equities, the global index has Canada at 3%, right? So there's this wide range.
Yeah.
It sounds like, kind of marrying all of these things together in terms of what you were talking about. We've got to find productive assets in Canada to invest in, not just I don't really know what rent-seeking assets. I don't know if that's like I don't know if that's too derogatory in terms of where a lot of Canadian investment capital gets sent to. What are your thoughts on that? If you're looking for the solid returns in Canada, considering everything you were talking about, like what do we want to sort of think about?
Well, and like I always say, I like to say to investors, let me arm you with questions, rather than say, try to tell you what I think the solutions are. Let arm you with good questions. So the first question is, are you long growth, short inflation? Are you disproportionately reliant on middle class demand? And the answer, I know the answer, it's going to be yes, right? Then you need to reevaluate that. And now this is the part I was postponing, like where it sounds kind of cynical and heartless. In a period of like when conditions, rapidly deteriorate and become much more stagflationary, and it's going to be the growth side of the equation, you can actually make very good returns, because volatility, it tends to favor some new asset classes, and they'll tend to have been out of favor, so they'll tend to been inexpensive, and so you actually can generate some very good returns, when the economic conditions turn over, if you know what I mean, right?
Right.
Because if everybody's been short inflation and long growth, then growth tends to be overpriced and inflation tends to be cheap, if you know what I mean. And so you can actually, if you're asking yourself those questions and you start to, you don't turn your whole portfolio into long inflation, short growth, but, shorten each one, right? And so like I'm not advocating, but I'll give you an example. Like here's an example of how something might change. Look at the automotive sector. So if you're in a high growth, low inflation world, you go long car manufacturers. You may or may not, but you know what I mean? Like they tend to benefit from those macro conditions. Well, when conditions go, like poor growth, high inflation, I wouldn't own a car manufacturer. right? I would suggest you could own car maintenance companies, because when the growth declines and inflation goes up, people stop buying cars. They own their cars much longer. They tend to consume a lot of automotive maintenance. You see the automotive maintenance sector in that kind of those macro conditions grow at like multiples of GDP. So that would have been an underlooked sector. It would tend to be cheap, and it would tend, you could get really good portfolio returns. I mean, these are things we do invest in, but I'm just giving you examples because I'm familiar with them. There'll be others as well, right? Farmland's a classic example. It's really resilient to stagflation. Why? Because on the inflation piece, it's a non-depreciating commodity producing asset. It does not deplete. So it's discounting the production of an infinite series of crops. So inflation ticks up, it disproportionately increases in value. It hedges the economic contraction because the demand for food is inelastic. People don't stop eating when the economy contracts. It's the last thing they stop doing. So like in the 1970s, farmland in Canada went up 400% nominal, 275% real. So just to give you an example, I want to make some optimistic observations, because there are things that do flourish. The good news is they tend to have been out of favor and come back into favor, and you do well. But I'll give you an example. A 5 to 10% allocation in farmland in the 1970s hedged all your downside risk to stocks, bonds, and real estate. All of it. Okay. You hedged all that downside risk. So now there's the issue is the things that hedge stagflation aren't that obvious. You got to do your work and go out and find them. But because they've, like, once again, to repeat, they tend to have been not in favor because, they're short growth, long inflation. You tend to find that they're less expensive, and you generate outsized, you can generate outsized returns. So all is not lost. I don't want people to think that. But what I would say to people is, it's not the kind of world where you can ignore it. You can't just go, my portfolio is X. It's I hate readjusting my portfolio. People do. They have a lot of inertia. They don't like to make changes. I don't think they have that luxury. I think they need to ask those questions. If the answers aren't appropriate, they need to take steps. And then that's where advisors come in handy, right? Because it is difficult to navigate stagflation. And you do need to really hunt things down that are going to do well. And now, once again, I'm not suggesting you run out the door and go, invert your portfolio, but you should certainly start to reduce your growth exposure and increase your inflation exposure.
Right. Yes. There was an interview with Ray Dalio, who sort of spoke about this kind of rising inflation, rising growth, slow inflation, slow growth. Like kind of, you can kind of create a metric. And, if you kind of have a, decent weight of assets sort of in each of those buckets, you should, that's almost an all-weather portfolio. And clearly it's not as simple as that, but, that's kind of the direction. And so I absolutely hear what you're saying.
Yeah. Like I'd be very worried if I opened, like I looked at my asset allocation and go, ooh, I'm really super long growth and really, really short inflation. I go, I don't think I should do that.
Right.
Yeah. I know I'm repeating it, but I'm trying to I'm just trying to distill down how, because people ask me this question quite frequently, and I'm trying to distill it into a simple sort of framework. And that really is as simple as it gets. Your long growth, short inflation, think about that.
Yeah, absolutely. And so just as we're starting to, this is maybe my last sort of full question. I mean, so and this maybe is, it's kind of, this maybe takes your investment hat off, your managing director hat off, just as, you're standing in the grocery store, you're talking to somebody, and someone listening to this, they're working, they're raising a family, they're planning retirement. I mean, what do you think they should take away from a conversation like this?
First of all this is fixable, because there's good news. Canada, in principle, has like on the asset side of the equation, has one of the best balance sheets in the world. If you think about, the endowment of resources and people, and honestly, peace, order, and good government. I know that we're living in quite fractious times, but there are lots of places in the world where, when people disagree, the buildings burned down in their civil war, so
Yeah.
we have a lot of things going in our favor. What we need to do is start having a public discussion about where growth comes from and where inflation comes from, and arrive at a consensus to fix it. And if we arrive at that consensus, we'll fix it. Because once again, good news, the asset side of Canada's balance sheet is amazing, right? So,
Yeah.
at least we've got that going for us. We just need the will, and it's not political will, because politicians are public servants. We need, as voters, we need to prioritize pocketbook issues. And that requires education. And we get back to, we need to understand where inflation comes from. We need to understand where growth comes from. And we need to talk about it. And we need to tell our politicians to prioritize that. And if they do, we'll fix it.
Right.
We will. And if we don't, we won't. I mean, but
yeah.
But once again, if we do, we will.
No, great. No, I hear you. That's great. And just as we're wrapping up here, and I'll include, links to your company and so on and so forth in the notes. But if people want to hear more of your thinking or follow what you're building, where should they go?
They can go to the website and they can log up, and there's a quarterly, investor update, but anybody can get it. And it discusses our macro view and then the specific fund performance. And I like this invitation, because I wasn't here to advocate for investments. This is a really important topic. And by the way, the question about what happened in Eastern Europe is a brilliant one. People should look at that world as like a little laboratory.
Right.
And, if they want to see how the future could look, it could look like Romania, or it could look like Estonia. And I've been to both those places, and trust me, you'd much prefer to live in Estonia.
Right. Okay.
So,
yeah. No, well, that was great. Stephen, thanks so much for your time and your insights. As I had mentioned to you, when I was kind of creating the invite for this, I'm a big fan of what the work you guys are doing. It's
thank you.
just even a kind of personal anecdote. I probably don't have it. I might have it around here, but there was some period of time during that kind of inflationary run up where I became obsessed with inflation. I read all the books. I have the history of interest rates and all that stuff here. And one little book that I had read was An Investor's Guide to Farmland, and and I read it and I thought, what a wonderful investment this is. This in particular in that sort of world that we're describing today. So so great work, and thank you so much.